In the previous lesson, we talked about the forecast of P&L items. And here we'll continue with the firm's balance sheet. We will explain how most modelers forecast trade receivables, inventory, trade payables, other assets, and other liabilities. We'll deal with the rest of the balance sheet items in our next lesson. So, having said that, we can start. Trade receivables, inventory, and trade payables are the three components forming working capital. This is the money that is locked in day-to-day operations. The most popular technique used to forecast these items is the so-called days technique. First, we calculate how many days are necessary to receive money from clients and cash trade receivables. How many days are necessary to convert inventory in sales on average, and in how many days the firm sends payments to its suppliers. Then, once this calculation has been made, we can calculate the average number of days and apply it for the forecast period. It is unreasonable to forecast significant changes to the existing averages if there are no specific reasons for that. Other assets and other liabilities are generic categories that group smaller items. Other liabilities will include deposits from clients, deferred taxes, unpaid taxes, and so on. This is a heterogeneous group of liabilities. The same is valid for other assets. They can include deposits for external services, prepaid expenses, deferred tax assets, and so on. We can't go into detail and forecast each of these lines for the entire forecast period. That is why we'll forecast they will develop in line with the business. We can calculate their historical weight on revenues and assume the average percentage observed historically will be observed in the future too. And this is how we can forecast trade receivables, inventory, other assets, trade payables, and other liabilities. Stay tuned for our next lesson, when we will talk about forecasting PP&E, financial liabilities, shareholders' equity, and cash.